Ladies and gentlemen, welcome to Albaraka Q1 2019 Financial Results Conference Call. I will now hand over to Mr. Ibrahim. Sir, please go ahead.
Good afternoon, everyone, and welcome to our first quarter of 2019 earnings call. In light of the constructive feedbacks we received with regards to diving straight into our financials, let me therefore comment on third slide of presentation. Despite what has been a very challenging year with the August 2018 lira devaluation and its subsequent reverberations, we managed to achieve some measured growth of our total assets in first quarter of 2019. The fund credit portfolio as well as funds collected in comparison to end of 2018 first quarter. In large part driven by the inflation of our balance sheet stemming from the TL depreciation, our total asset size expanded by 5.6% year to date to reach 44.6 billion Turkish lira. Total fund credits showed a more humble 1.2% year-to-date growth, reaching to 26.5 billion Turkish lira on the back of our more cautious approach to balance sheet growth, given the challenges in the operating environment, as well as our emphasis on a more balanced approach to deleveraging the balance sheet. Our fund credits book now constitutes 59% of total assets as of first quarter and is still an important portion of total assets despite the slower growth pace. Turkish lira funded credits and FC fund credits represented 46% and 54% respectively of the aggregate loan book. Deposits, on the other hand, grew by 7% year-to-date, reaching to 30.6 billion Turkish lira. The result of this, of course, is that our aggregate loan-to-deposit ratio now stands at around 86.5, roughly 3% less than the participation banking sector average, and circa 27 less than the banking sector at large, which has a loan-to-deposit ratio of almost 114%. Our shareholder security, thanks in large part to $205 million Tier 1 issue we completed in 2018, increased to 3.26 billion Turkish lira. Our capital adequacy ratio declined 109 bips to reach 13.57% as of first quarter, while our Tier 1 ratio has come down 53 bips to reach 9.45%. In terms of NPL volumes, we witnessed an increase of 8.3% in our total stage 3 credit stock, which reached 2.05 billion Turkish lira at the end of last year. This was more or less in line with the participation bank sector, which witnessed, in fact, a NPL growth of 14.3% year-on-year in 2019 first quarter. The banking sector, which we saw an increase of 1.5% throughout the first quarter. Our NPL ratio did inch up 7.36% from 6.68% at the end of first quarter 2019, although I would merely adhere that the deterioration in the NPL ratio did not just come from similar to market NPL formation, but rather the muted growth in our overall fund credit book. Our net profit share margin declined 21.5% year-on-year to reach 196 million Turkish lira as of first quarter. This resulted in a net profit share margin of 2.55%, which corresponds to 116 bips year-to-date drop from the first quarter of 2018. When it was 3%, 35%. Net fees and commissions income grew by 75% year-on-year, reaching to 70 million Turkish lira in first quarter. The growth in this line item is mostly driven by rising revenues from POS services, as well as fees on custody accounts, which we have started offering investors. The non-funded credit book, despite the deceleration in economic activity, has also helped boost this figure. As a result of the ongoing implications of IFRS 9 and 16, as well as the rebalancing macroeconomic environment, our provisions for loan losses expanded by 26.4% year-on-year to 325 million Turkish lira. Our total coverage ratio stood at around 62.6 versus 66.5 3 months ago. While our coverage for stage 3 credits stood at 52.3% as of the end of the first quarter of 2019 versus 47.3% at the end of 2018. Total operating expenses grew by 20% year-on-year. However, we have seen a considerable drop in the cost-income ratio, 42.88, which was 59.7 due to one-off relation cost in fourth quarter 2018. HR costs grew by 35.1% year-on-year, in line with our budget, while non-HR expenses grew by 3% year-on-year. And finally, our net profit came in at year-end at 27 million Turkish lira, marking a 72.4% year-on-year drop and resulting in a very humble return on equity of 1.9%. There are no doubts that a bigger standout development is the considerable drop in bottom line profitability comparing first quarter 2019 and the first quarter of 18 as a result of various factors. A gradual and structural change in the funding mix towards more higher pricing compared to deposit products such as TL-dominated sukuks, as well as other new industry products, which is leading to weighted average cost of funding. Despite the higher rate environment, loan repricing on the asset side is coming with a lag, and in our case, particularly taking into account limited new loan growth. The above factors are naturally putting pressure on operating margins, something we see across the Turkish banking sector at the moment, particularly with near flattish lira loan-to-deposit spreads. Again, the inflationary environment is continuing to also pressure operating expenses, and moving forward, we will be in line with our banking peers, continuing to take a close look at how we can increase operational efficiency with our cost optimization initiatives. So, as a result of these factors, our reported net profit share margin showed a material drop in first quarter of 2019 and stood at 2.55% with a near 25 bips drop over 3 months ago. Overall, our capital adequacy ratio 57% at first quarter still remains comfortably above the regulator comfort threshold of 12% and well above Basel III requirements of 8%, while our core equity ratio drops to 7.16% from 7.56%. Nevertheless, our AT1 sukuk has provided an additional cushion of 2.29 to overall capital adequacy ratio. Let me start with the asset segmentation graph on the slide 5, upper left corner. Asset composition has somewhat changed. At the end of 2019 first quarter, the funded credits portfolio represents 59.4% of our total assets, with a 10% decline from a year ago. Our securities portfolio, which now represents 8% of total assets, has expanded to 3.53 billion Turkish lira, with Turkish Treasury sukuk representing over 67% of the entire portfolio. 63% of the portfolio is lira dominated, with the remaining portion is FC denominated. The yield on the securities book has increased 314 bips over the last year and 8 bips over the last quarter alone to reach 12.92%. Other liquid assets, consisting mostly of cash and cash equivalents, now represent 28%. Obviously, the drop in the outstanding fund credits as a percent of our assets has filtered through on the back of our more conservative loan to deposit ratios and have led to our high quality liquid assets build up in fourth quarter of last year and first quarter of this year. These two has come at a relative opportunity. Cost of opportunity as usually high quality assets don't generate the same yield pickup as natural fund credits. With regards to these high quality liquid assets, they now represent 34.7% of all assets. This was a reflection of our balanced approach to ensuring a liquid balance sheet as a mitigant to the challenging operational environment. During first quarter, our average liquidity coverage ratios on both FC as well as FC plus LC were 231% and 270% respectively. These are well above the regulatory requirements of 8% and 100%. Our cash and balance with central bank and interbank placements increased by 71% from over a year ago to reach 12.5 billion Turkish lira in first quarter. Roughly 20% of these liquid assets are Turkish lira denominated, while 80% are foreign currency denominated. This is in large part of a reflection, I think, of low demand for FC credits at the moment and the high embedded dollarization rate of deposit base. With regards to operating performance, on slide 6, I'm going to now spend some time here going into individual line items on both the income side and expenses side. Let me begin with the cost and yield movement first. The yield on blended fund credits portfolio increased 40% year on year to reach 10%, 10.6%. If you look at the blended loan book yield, after adjusting for JV projects and the FX index loans as first quarter, our loan yield was actually 10.9%, representing a 110 bips increase from first quarter of last year. Blended cost of collected funds increased 134 bips year on year to reach 7.17%. Reported net profit share margin substantially narrowed 116 bips year on year to reach 2.55%. However, JV adjusted net profit share margin has actually declined by 62 bips year on year to reach 2.62%. Headline profit share income in first quarter increased 27.3% year on year to reach 844 million Turkish lira. Profit share income from our funded credits portfolio represents 91% of total profit share income in first quarter. As our revenue generating assets mostly composed of these credits, while the securities portfolio contributed 7.2% of total profit share income in this quarter. Given our strong liquidity position at the moment, due to the lower loan to deposit ratio, we believe we are better equipped to deliver stronger lending expansion after the second half of the year, when we expect to see a loan raise in the market at lower levels, which can trigger loan demand and ensure enhanced debt servicing capacity of the borrowers. So we don't expect a structural change in our profit share income composition in the near future. When it comes to the details of the yields of funded credit portfolio, we see that our blended funded credit portfolio yield has increased 110% year on year to reach 10.9%. Turkish lira funded credit portfolio yield has increased 320% bips year on year to reach 16.6%. FC funded credit portfolio yield has stood at same level of 6.4%. Headline profit share expenses increased 57% year on year to reach 648 million Turkish lira due to change in our funding mix, as mentioned earlier, and due to the weaker lira. The composition of profit share expense changed in 2018 and in the first quarter of this year. 71% of total profit share expenses was composed of collected funds in first quarter 2018, but this ratio dropped to 63% of collected funds at the end of first quarter. We may see a similar pattern continue at least into first half. The downward path of inflation is supposed to bring down cost of lira funding in the second half of 19, so that our funding mix normalizes in favor of participation accounts. When it comes to the details of our funding costs, we see that our blended deposit cost has increased 353 bips year on year to reach 7.17%. Turkish lira deposit cost has increased 267 bips year on year to reach 12.63%. FC deposit cost has increased 62 bips year on year to reach 2.56%. Expenses related to the wholesale funding now represents 37 of all profit share expenses. As mentioned earlier, the rising exposure to the lira-dominated sukuks and new competitive return deposit products for customers, as well as the rising costs of FC funding, lifted up the profit share expenses on wholesale borrowings, which increased year-on-year roughly 91% as of first quarter to reach 225 million Turkish lira. We will see the expenses of wholesale funding cool down after second half of the year, in tandem with the anticipated decline in inflation, as well as our ongoing FC deleveraging on the liability side, which will provide material relief commencing in the second half. Our net profit share income came in at 196 million Turkish lira in first quarter, though contracting by nearly 22% year-on-year. Net fees and commissions reached to 70 million Turkish lira for first quarter, circa 75% year-on-year expansion in this line item is mostly driven by higher POS commissions, and custody services, despite the deceleration in economic activity leading to slower loan growth. Net fees related to non-cash credits and banking operations income did also well due to the continued growth of our off-balance sheet business, which had to do somewhat offset the lower than expected fees from cash credit business due to the slowing of new cash credits growth. Our trading income for the first quarter increased 98.8 year-on-year to reach 67 million Turkish lira, thanks to the major contribution in income generated from a foreign exchange position stemming from our Tier 1 sukuk transaction and the remaining amounts resulting from the capital market gains. In terms of composition of the fund credits portfolio, roughly 46% was TL dominated and 54% FC dominated as of end of first quarter, whereas our corporate and SME exposure represented 48.6% and 41.9% of the credit portfolio, and retail exposure declining to the roughly 9.6%. Let me also spend some time here on slide 8, asset quality. This is obviously a critical area. Our NPL ratio inched up 7.36% as of the first quarter, corresponding to 202 bps year-on-year increase. While NPL inflows increased due to deceleration in economic activity led by the weaker lira, the higher inflation and elevated interest rates, our ratio itself was also impacted by very muted loan growth in first quarter. Nevertheless, our stage 3 NPL coverage of 52.3% combined with the fund credits over collateralization provides some mitigations. If we take a look at our gross fund credits by stage, what we see is our loan book in terms of stage 1 credits, those without any significant credit risk increase, now represents 77.6% of the total gross funded credits. Our loan book in terms of stage 2 credits now represents 15.1% of the gross loan portfolio. Our loan book in terms of stage 3 credits, those which are impaired, now represents 7.36% of the loan book. In terms of provisioning ratio, stage 1 has a 0.5% coverage rate, stage 2 credits has 2.3% coverage rate. Stage 3 credits has 52.3 coverage rate. In terms of cost of risk, our trailing 4 quarters gross cost of risk ratio stood at 218 bips in first quarter, with a marginal 25 bips decrease over a year ago. On slide 9, asset quality slides again. Gross NPL inflows in first quarter were parallel to the banking sector average with TL 390 million, but NPL recoveries increased 50% in first quarter, previous quarter to 78 million inflow, resulting in net NPL inflow of 237 million Turkish lira. Therefore, the net NPL formation rate climbed up to 363% bips in first quarter from 272 bips in the previous quarter. When we look at the sector distribution of the NPL inflows in terms of customers classification, in first quarter, inflows are as follows, as in the graph. Large part of the inflows has coming from the communication. We witnessed a 315 bips Turkish lira billion gross NPL inflow in first quarter 2019. Construction, including loan files related to construction of power plant projects, manufacturing and wholesale trade were the main areas that NPL inflows came from. When it comes to the sector breakdown for stage 2 loans, which amount to 4.2 Turkish lira, the manufacturing industry dominated with 35.6 stake, followed by construction with 20.5% and energy with 17.8% stake. Although our cash coverage is low at 2.3% for stage 2 loans, we have strong collateral at 2.9 billion Turkish lira. We have 72.3% cash coverage from our stage 3 loans. But again, with the Turkish lira 1.34 billion Turkish lira collateral portfolio, we feel comfortable. Wholesale funding, which is on slide 10, now represent 21% of all liabilities. Total wholesale funding, which includes our interbank borrowings, sukuk issuances, and syndicated loans, increased 6.6% year to date. In first quarters, it reaches to 9.4 billion, although this increase stemmed from Turkish lira depreciation. As we already announced to the investment community more than a year ago, we repaid our 315 million syndicated loan facility at the end of November, after the November 2018 and the April 2019, in line with our deleveraging intention. We have two main hard currency borrowings maturing in 2019, which was in April 2019, are $245 million and 60 million euro syndicated loan matured April and paid back. In June 2019, our 5-year 350 million senior sukuk, dollar senior sukuk, which is the maturity. At the moment, we have paid, as we mentioned, syndicated loans and we are planning to repay senior sukuk in line with our FC liability, deleveraging and existing strong FC liquidity. We have not tried rolling them over as global funding is increasingly becoming a drag on profit share expenses given the rate increase and currency impact. Subordinated loans represent 3% of all our liabilities. We have seen an increase in our overall subordinate debt from 1.2 billion to 1.3 billion in first quarter. Our total shareholders' equity has stood at same level of 3.26 billion Turkish lira. On slide 11, our aggregate deposit base increased circa 7% year to date in first quarter 2019 to reach 30.6 billion Turkish lira. The breakdown of these collected funds in terms of how much are sitting in current accounts versus participation accounts for the end of first quarter was 32% to 68%. The breakdown of our total deposit base for the same period in terms of TL dominated versus FC dominated funds was 37% and 63% respectively. In terms of underlying trends, Turkish lira current accounts increased 2.7% year to date. Turkish lira participation accounts contracted 5.8% year to date. FC current accounts increased 10.6% year to date in real terms. FC current accounts increased 6.3% year to date in real terms. The contraction in the Turkish lira participation accounts was mostly captured by migrations to the newer price competitive deposit products I mentioned earlier, albeit at the marginal cost of profitability. In terms of cost of funds collected, TL cost of funding has increased 353 bps year on year to reach 11.31%. FC cost of funding has increased 62 bps year on year to reach 2.56%. Average cost of funding has increased 139 bps year on year to reach 7.36%. If we take a broader view and consider the 25.2 year-on-year growth in deposits for the overall banking sector, and subsequently take into the account an ongoing deposit yield differential between our sector and the industry at large, we are generally content with the overall figures, although disappointed with the Turkish lira deposit growth figures, which we believe will pick up. On slide 12, off-balance sheet assessment slides, total off-balance commitments increased 8.7% year on year to reach Turkish lira 12.4 billion Turkish lira for the first quarter. In terms of breakdown, 40.2% of these commitments are LGs, 60.9% of these commitments are LCs, and 52.9% are other items such as irrevocable commitments, derivative financial transactions. Trends-wise, there is a healthy growth across all the main areas in our off-balance sheet areas. The growth in this area is a reflection of the efforts being placed to go into position our bank as an SME-friendly institution. which can meet all the trade finance requirements of our customers. This is being matched by an active financial institution strategy to expand our correspondent banking network. On slide 13, income cost dynamics, I think we have gone into most of these dynamics in some detail early in the call. Again, on slide 14, our financial ratios reflect a fairly clear picture of us all. I believe we are facing some headwinds and trends, albeit to different degrees. We are going through a period of operational margin pressures given temporary market dynamics and naturally witnessing the pass-through effect of TL depreciation in August 2018 and first quarter of this year on asset quality, and provisioning, which combined with the inflationary pressures on other operating expenses are all pressuring bottom line profitability. Yet, we are cautiously optimistic that a turnaround after the second half of the year is very much on the cards, and we believe we will be well positioned to see a recovery as a result of our sound liquidity and conservative LDRs, which give us a room for credit expansion. This brings us to the end of our financial results presentation. Thank you for taking the time to join us on this call.